Welcome to The Explainer. This is what we take on really complex topics and, well, we make them simple and give you stuff you can actually use.
So let me ask you something. If you own taxable bonds, is there a chance you might be overpaying on your taxes? I'm going to bet there's a pretty good chance. You see, there's this hidden little compliance trap, and it's lurking on a tax form you get every single year. And it could be costing you real money.
Okay, so let's just dive right into this. We're going to run a super simple audit of your tax forms. Our goal? To find this error, fix it, and make absolutely sure you are not paying the IRS 1 penny more than you actually owe.
To really get what's going on, we first have to wrap our heads around this thing called bond premium. Trust me, it's the key to understanding everything that's about to follow.
So you're probably wondering, why in the world would I pay more than a bond is worth? And that's a great question. It's actually pretty simple. You do it because that bond is paying a higher interest rate than new bonds on the market. You're basically paying a little extra upfront to lock in a better stream of income down the road.
Now this is the crucial part to remember. That extra premium you paid, it kind of wastes away slowly over the life of the bond. So every time you get a coupon payment, it's not all pure profit. No. Part of that payment is just the bond giving you back a little piece of the premium you paid in the first place. It's literally a return of your own capital.
Okay, this is where it gets really interesting. The IRS under Internal Revenue Code Section 171 actually gives you a choice on how you handle this premium for tax purposes. You've got two options, and let me tell you, one is way, way better than the other.
And this slide really lays out the two different paths you can take. If you do nothing, the default, you pay tax on all the interest you receive now, and then you get a less useful capital loss way, way down the road. But if you make the smart choice and elect to amortize, you get to reduce your taxable interest income every single year. And that gives you an immediate, high-value tax benefit right now, which is what we all want, right? Now, making this choice isn't just some casual bond-by-bond decision. Oh no, this is a formal tax election. Once you decide to amortize, it applies to all the taxable bonds you own now and any you buy in the future. And you can't just change your mind. It's pretty much irrevocable. The good news? All you have to do to make the election is just report it properly on your tax return.
All right, let's get to the real heart of the problem here. We're going to see how your broker's own reporting can actually set you up to overpay, even when you're trying to do everything right.
And check this out. This is basically the smoking gun. These IRS regulations right here, they literally require your broker to assume you're making the smart choice, that you've elected to amortize. They have to operate as if you want that yearly tax benefit.
So when you get that Form 1099 INT in the mail, your broker has already done the heavy lifting for you. Box 1, that's going to show the total interest cash that landed in your account. But then look at Box 11. That number shows the piece of that cash that was just a return of your premium, you know, the part you shouldn't have to pay tax on.
And here it is, the trap in all its glory. Your broker, following the rules, puts that number in Box 11 for you. At the same time, behind the scenes, they reduce your bond's cost basis. Now, if you, or your tax software, just grab that big number from Box 1 and completely ignore Box 11, you've just overpaid. You paid tax on money that wasn't even income. And because your basis was also lowered, you're now set up to pay tax again on a bigger capital gain when you sell. That, my friends, is double taxation.
Okay, I know, that was the bad news. But here's the good news. Finding this and fixing it is actually incredibly simple. You just have to run a really quick audit on your own records. So here's your action plan. It's just 3 easy steps. First, go find your 1099 INT forms for the past 3 years. Just look for any number, anything at all, in Box 11. Second, pull up your tax returns for those same years and look at Schedule B. Did you list a subtraction for that Box 11 amount? It's usually labeled something like ABP Adjustment. If the answer is no, congratulations, you found the error.
And you know what finding this error means? It means you can most likely get that money back. All you have to do is file an amended tax return, that's Form 1040X, for any of the last 3 years to correct the mistake. And then you can claim a refund for the taxes you overpaid.
You know, we're not just talking about pennies here. For people with some serious bond holdings, this little hidden error can add up to thousands of dollars in overpaid tax. By running this simple audit, you can make sure your money stays exactly where it belongs, with you.